Hello there, gentlemen. This is your captain speaking. If you could please secure your tray table and bring your seat into the upright position, we're about to begin our next seven lecture. And helping you navigate the economic path ahead, I'm Matthew Mills. And ladies and gentlemen, we know that you have a choice in lecture series you could attend, and we're grateful that you've chosen to come to the seven lectures. Our destination for this lecture is the deficit diatribe, or why a sterling promise might not be quite as gilt-edged as it used to be. Now, if you've been following any kind of news whatsoever over the last 6 months or so, you'll know the thing that's preoccupying politicians, individuals, business owners, and investors alike is the spectre of inflation. And here we can see a chart which shows price inflation in the UK since basically the end of the 1950s. And what we can see is that the rate of inflation has rocketed up just recently, getting to near the kind of levels we saw in the time of flares and disco balls in the 1970s. Now, I was going to start by saying that actually, unless you've been living in a cave, you would have noticed that the thing that's coincident with the rise in inflation is the rise in energy prices. But of course, if you've been living in a cage, you probably haven't got a supply of gas or electricity. So that metaphor doesn't really work. But nonetheless, this chart here shows the astronomical increase in energy prices that we've experienced over the last year. Largely, this is due to the fact that the energy supplies, particularly gas and oil, into Europe are supplied by Russia, who have pretty much decided to turn the taps off after the invasion of Ukraine and subsequent sanctions by the developed countries. The cost of heating our homes, particularly as we go into the winter, and our hospitals and our businesses, has doubled and then quadrupled as a result of the issues in Ukraine and also the high levels of background inflation. And the government, we got a new Chancellor in particular, feel that they now need to do something, and their plan was put forward last week. Essentially, what they intend to do is to cut personal tax, so you and I will pay less money and have more disposable income to support ourselves and our families. They're going to cut corporation tax, so companies will become more competitive. But what they'll also be able to do is hire more people who can then earn more money and support their families. And government intends to provide an energy price guarantee, a cap on prices to support individuals and companies through both this winter and through the next. And the hope is that in the longer term as well, these changes make our country more competitive and that we can grow the economy and basically grow our way out of this, which will be the thing that's going to ultimately pay for everything the country is going to do now. So basically, we're going to spend some money now and hopefully grow the economy in the future, and that's ultimately downstream what's going to pay for it all. Now, before we get into the meat of the consequences of the Chancellor's announcement, pun intended, here's another stunning statistic, an attention break brought to you by SE7EN, which is that obviously the lion's share of the cost of living crisis has been driven by the diminution in gas and energy supplies from Russia, which is pushing up prices for everyone. And we're all looking at alternatives. Now, one of the contributors to global warming is, in fact, cow flaters. It's actually a significant contributor, but also potentially part of the solution, because an average cow, in terms of its bottom burps and its front burps, produces about 100 kilograms of methane per annum, which, if you captured all of the energy in that, is enough to power the average household for about a month or so. Once again, as we're chewing the cud on alternative energy supplies, facing the energy crisis going into winter, something to think about. Now, the Chancellor intends to pay for all of these tax cuts and support for us with borrowing. Governments can borrow just like individuals from other governments and investors all around the world. Now, this chart here shows borrowing of the UK government since basically the end of the Second World War. And at the end of the Second World War, we were basically broke as a country. We were on our knees financially, and through economic growth and trade and through austerity at other occasions, cutting back on costs, we've managed to reduce the level of national debt relative to the amount of money that our country earns, GDP. That was up until around 2009 when we had the credit crunch and we all had to bail out the banks. And I haven't put the figure here. It runs into some trillions that the government had to spend from borrowing to do that. Then as we go into the pandemic, the government borrowed 70 billion for the furlough and about 350 billion in total to support the way we dealt with coronavirus. And what the Chancellor is now planning to do is to borrow at least another 150 billion now. Possibly he's hinted some more coming into next year to support this package of measures and support. Now, one of the issues with this is that governments, just like individuals, have a certain level of income, and there comes a point where you borrow so much and are paying so much interest that it raises some question marks about whether you can actually continue paying the debt or not. Now, one of the consequences to the Chancellor's announcement was that the pound fell in value sharply against the dollar and a number of other major currencies around the world. Now, the reason that happened is that essentially investors have said their level of trust in the UK economy and therefore in its currency is falling. And I'll put a little label up here. You can go back and visit. We did a lecture on the value of money and how it is based upon trust as a share of an economy, and you can go back and have a look at that. So basically, what investors have said is, we're not sure where this policy is going. We're not sure what it's going to do to your economy. We're a little bit worried about the amount of money you're borrowing and the amount that you're going to spend back. And as a result, the value of your currency is worth a little bit less to us. So basically, the Chancellor is going to borrow at least another 150 billion quid from governments and investors around the world. But when we're approaching borrowing at its costs of around, which approach 100% of our national income, just like there would be with an individual who's looking to borrow to buy a house, if they're spending all of their income, then if there's any disturbance whatsoever, then their ability to pay is then called into question. And it calls into question, in this context, confidence in the UK economy overall. As we have said, the value of a currency is basically a share of an economy. Therefore, the value of sterling has fallen as confidence in our economic strength has fallen. And a consequence of that is that the Bank of England is likely to raise interest rates so that anyone who is investing in sterling is rewarded with a higher return. The big problem with that is it will increase the debt burden for individuals in the UK, homeowners and business owners alike. And it's entirely possible that that will push our economy into recession, that will start going backwards because we're carrying a bigger debt burden as individuals and companies than we otherwise might be able to. And it's that fear that feeds back into our further doubts over our ability to pay, because if our debts are going up and our ability to pay goes down, then basically our economy is going backwards. What the Chancellor is actually hedging his bets on here is that the tax cuts for individuals and companies and the support given will actually lead to growth. But the issue with his plan A is if it doesn't work, it leads down a recessionary route and a reduced ability to pay that debt. And it doesn't seem to be a plan B, and that's the thing that's worrying investors. Now, while the Chancellor may have only a plan B and no plan B, as diligent investors, it's essentially we have a plan X, Y, and Z, just in case, a Z for our international viewers here. First and foremost is to have a plan, is to actually rather run around like a headless chicken, just reacting to what's going on and to different news flows, possibly becoming slightly hysterical as a result. Let's calmly and objectively consider the situation, recognise that this is a plan in history, and not give in to fear. Equally, in a previous lecture, we've talked about contingency planning in preparation for a cost of living driven recession. And what we should be having are short, medium and long-term contingencies to deal with any disruption. And that's just a fundamental underpinning of long-term strategic planning to meet our objectives. Now, we did a lecture on that one, and I'll put a little link up to it here, and you can go back and revisit that rather than me go through it all again now. One of the great advantages of YouTube is how you can link content like this for greater utility. It's as if we've thought about this before. Anyway, final one is that if you're an investor, there are potentially some alterations in portfolios that might be implied by what's going on. I mean, basically, if interest rates in banks are going up to 5 or 6%, which they might well do by this time next year, if you're chasing a return of 5 or 6%, you can get it from a bank rather than anywhere else. So you might go there. Alternatively, if the confidence in governments to support their debt is going down, then government loan stocks might drop in value, and you might not want to be there as a hedge against equity risk. But that's something else we can talk about another time, and we'll probably do a lecture on that one. The real point, though, is that in response to short-term market movements, we shouldn't be making rash decisions about our long-term investment strategy. So after a whistle-stop tour of the Chancellor's latest statement, we're now coming in for a landing on this lecture. But what have we learned? Well, the UK government is just introducing a really aggressive spending policy in the face of rising prices and energy costs in the hope that they can soften the blow for us as individuals and companies now and hopefully grow our way out of this in the medium to long term. However, given the levels of borrowing that this government has already racked up with the credit crunch, with dealing with the pandemic and keeping us all at home and all the other issues with it, investors around the world who are the ones that the government will go and ask for the money have called into question the government's ability to pay this debt in the longer term. And that's been reflected in the pound falling in value and in UK stock markets falling in value, as global investors basically say we're having a little bit of a crisis of confidence here. Now, that said, as diligent investors, what we're not going to do is give in to panic. What we've learnt to do over time, hopefully reinforced repeatedly in this lecture series, is we plan contingencies against a downturn in the short and the medium term, but we don't make rash investments in the longer term that could derail our strategic planning and getting where we want to be many years from now. And it's because of the actions of our Chancellor that we tend to give out warnings like past performance cannot be a guarantee of the future, because you just don't know what they're going to do next. However, what we do know we're going to do before we finish is we're going to say that this video is intended to inform, to educate and to entertain, and most certainly does not represent advice. However, on that basis, with another lecture to come in the not too distant future, we will hope to see you next time. Thanks for tuning in.